There's a problem going on in the financial world, and the worst part is no one's even paying attention to it. See, the sad reality is that people aren't saving enough for retirement. It's estimated that Americans have $65,000 put aside for retirement, which will reach $250,000 by the time they reach retirement age. See, if you were to get a $250,000 case on an episode of Deal or No Deal, you'd probably be jumping around and ecstatic for the next 2 months. But if I were to tell you that you only have that much to last you 20, 30 years or the rest of your retirement, I don't know how happy you're going to be. But you're in luck, because I'm here to teach you everything about retirement planning, how much you need, how to get what you need, and how to do it all with tax advantages. The sooner you start planning and saving for retirement, the more money you'll have, the less you'll have to rely on the government, and the more you'll actually be able to enjoy your retirement. And that's simply because of compound interest. So what is compound interest that you're talking about? In simple terms, compound interest is referring to the gains that you get on your gains. Let's draw this out for you. Say you have $1,000 invested on year 0. After 1 year, you have a 10% return. At the end of year 1, you have a total balance of $1,100. $1,000, which was your principal or your initial investment, and then a $100 gain. You don't touch this money, you let it grow another year. Year 2, it has another 10% rate of return. Same money, same rate of return. Now you have $1,210 with a gain of $110. In year 1, you only had a gain of $100. Year 2, you had a gain of $110. And this is because you got gains on your gains. And what's so powerful about this is when you look at this over 20, 30 years, the gains are exponential. And this is simply why it's so critical to start early. You may be thinking, I'm 20, I don't need to start retirement planning. I'll start when I'm 50. Say you started investing for retirement at the age of 20 with $200 a month. And say you want to retire at age 60. That gives you 40 years to grow your money. If you invest $200 every single month until retirement, you'll have over $1 million. But you only invested $96,000, and that's assuming a 10% rate of return. Now say you waited 10 years and started planning for retirement and investing for retirement at 30, but you invested that same $200 with that same 10% rate of return. This means over the next 30 years, you'll have invested $72,000 of your personal money for a total balance of $400,000. See how important it is to start early? By starting 10 years early, you only invested $24,000 more, but your total balance was more than double than it was if you started 10 years later. But to get into the planning, before you need to know how much you actually need for retirement or when you should start investing for retirement, you need to know where you want to be during retirement. Step number 1 would be figure out your expenses today and adjust that for inflation when you want to retire. So if you spend $40,000 this year and you want to retire in 25 years, that means you're going to need $75,000 every year in retirement. Because of the 4% rule, you want to multiply the $75,000 by 25, and that gives you how much you need invested to last your retirement. So in this case, it's $1.8 million for retirement. But this could be overestimating if you want to pay off your mortgage before retirement and not spend so much during retirement. So now that you know how much you want for retirement every single year, you could start investing, and you do this within your tax advantage retirement accounts. And the ones I'm going to be talking about specifically today are my 2 favorites, which is the 401k and the IRA. A 401k can only be offered by an employer. You cannot open this up if your employee does not offer it, while an IRA stands for individual retirement account, so you can open this up without any employer sponsoring it. But this comes at a cost. With an IRA, you have a much lower contribution limit at $6,500. On the other hand, with a 401k, you can contribute just over $22,000 every single year. And then one of the biggest advantages with a 401k that the IRA doesn't have is your company's match. Most of the times, if your company is offering a 401k, they're going to offer you an incentive to invest into that 401k. And most of the time, this comes in the form of a match. So whatever money you put in, up to a certain limit, they're going to match that. If you put in 3% of your paycheck, they'll put 3% of your paycheck into your 401k. And then sometimes they'll even put another 3% without you even having to invest in your 401k. So by putting 3% into your 401k, you're getting a total of 9% of your paycheck. So take advantage of your company's match if they do have it. Now your 401k and your IRA are just the accounts. Within these, you can either go the Roth route or the traditional route. Most people have a misconception that you can only have a Roth IRA and you can't have a Roth 401k, and that's not necessarily true. Roth means that you're investing with your post-tax money. So if you open up a Roth IRA, you're investing with the money you get from your paycheck after you already have paid taxes, and then when you withdraw it during retirement, you do not need to pay taxes. So you only pay taxes once, and that's now. On the other hand, if you have a traditional 401k, this means that you're investing with your pre-tax money, your money before it gets taxed. This is for people that think they're gonna make less in retirement. So if you're in the highest tax bracket right now at 37%, you're probably gonna wanna go the traditional route and defer your taxes until retirement, because there's a possibility your taxes may be lower than 37%. But if you're getting taxed 12% nowadays, you're probably gonna wanna pay taxes now, not have to deal with them later, because you might be making more money in retirement than you are now. In turn, you're gonna be taxed more. Simply put, if you think you're going to be taxed more in retirement, pay taxes now through a Roth. If you think you're going to be taxed less during retirement, pay taxes later with a traditional. Aside from these small differences, there are many other differences that we can go through in a different video. So let me know in the comments below if you want a deep dive on the differences between a Roth IRA and a 401k. Aside from these two accounts, the third account that's probably the most tax advantage is your health savings account or your HSA. This is an account that's triple tax advantage. Yes. Not one, not two, but 3 tax advantages within this account. This account is so powerful that the contribution limits every single year is just under $4,000. So the first tax advantage with this account is any contributions you make can be deducted off your income, so you're paying less taxes now. The second tax advantage with an HSA is that it's tax deferred, or the taxes are pushed out till later. And the third, if these funds are used towards medical expenses, those expenses are tax free. And the bright side about the HSA is just like the 401k, sometimes employers will contribute into your HSA for free, and all you have to do is get like a physical or prove that you're healthy every single year. And that's free money to your pocket with no catch. But with the HSA, you're not able to use this on anything other than health expenses up to the age of 65. After the age of 65, you can withdraw and use this like any other funds, but it will be taxed. Now that you know where to invest your money, what do you invest in? The key to investing for retirement is having long-term outlook. These are funds that you're going to be putting aside for 30, 20, 40 years. I don't know how old you are. Anyways, you're going to want to be putting these funds aside for a long time. So with that being said, you don't want to put all your eggs on one company. Even though you think this is the biggest company in the world right now, you don't want to go in all on Apple because things do change. 20 years ago, the biggest company in the world was GE, and it was actually worth more back then than it is now. Imagine you put all your retirement funds in GE back then thinking,
it's the biggest company in the world. It can't go down. It's gonna blow up.
Well, we know how that turned out. So instead of investing in individual companies, you want to invest in diversified funds like index funds. Something like VTR or VU, which tracks the S&P 500 or the total stock market, historically has returned 8 to 11%. And I'm not saying that historic performance is guarantee of future performance, but it is a good indicator. Other things that you can diversify into is bonds. Bonds are some of the safest investments out there, especially US Treasury bonds, because this is basically an IOU from the government. So bonds are also very good for retirement. As you get closer to retirement, you want to make sure that you're checking your retirement plans. You don't want to just set these once when you're 25 years old and never check them again. Things change, the economy changes, your wants change, your mortgage may change, your job may change. So make sure to review these maybe once every year, once every 2 years. It's not that urgent. Set it and forget it. This isn't meant to be stressful on something that you're checking every single day. If you want to completely set it and forget it, one thing that you can do is invest in a target retirement fund. These are awesome because they rebalance themselves. The way these work is if you're looking to retire in 2050, these target retirement funds will have stocks, bonds, whatever is in there, and it'll readjust as you get closer. So if you're 30 years away from your retirement, it's going to be mostly stocks, some bonds, and then as you get closer to retirement, it's going to automatically adjust to more bonds, less stocks, so it's less risky. These are great for people who just want to set it, don't want to manage anything, so look into your target retirement funds if that's something you want. So today we went over all things retirement planning. We went over how to figure out how much you need for retirement, where to invest, some tax advantage accounts, what to invest in, and a few other things in between. If you enjoyed it, make sure to hit that like button, drop a comment. I want to know your guys' thoughts. Hit the subscribe button, share with a friend, and we'll see you guys in the next one.